Stocks don't really become less risky the longer you hold them. This is an opinion piece from over 2 years ago from my man Meyer Statman and he's writing in Market Watch. I actually quote him in my book. You can retire on Social Security. Here it is right here. Shameless plug. Don't forget to buy it on Amazon. You can retire on Social Security. But we're going to read a little bit about this. But before I do, I want to show you this one thing. This is a graph. You get all kinds of graphs like this. The longer the holding period, the lower the historical likelihood of losses. I cannot disagree with this more. And I find it to be actually, I find this argument to be bad on its face. And the reason for that is I'll share with you in just a second. But everyone falls for it. It's like, oh, and I did a video similar to this about a year ago. And people are like, you're wrong, Josh. If you hold it for 10 years, you're not less likely to lose money. I'm telling you, you got to look at it differently. So let's talk about this. So here's from a big pickapp.co. I think they're in Canada. And they're looking at Canadian and U.S. stocks down here in the disclosures. And so they're basically got U.S. stocks, international stocks, balanced portfolio, bonds, and T-bills. And what they're saying is, look, on any one-year rolling periods from essentially 1926 U.S., and I think it's 1931, and 1935 Canadian, you had anywhere between 69% loss and 160% gain on any 12-month period. All right, so that's how many times that is. This is nuts. Now, you average 13% rate of return. So on any one-year time frame, you had 13% average rate of return, 1 year, 12 rolling months, I should say, but you had a portfolio that ranged from 69% to 167% up. 75% of the time, and again, this is U.S. and Canada, you made money. You had positive returns on any 1 year time frame, and 75%, but you averaged 13%. Hope that makes sense. So let me just revisit this again. So 75% in U.S. or Canadian stocks, 75% of the time you made money. The average return for that 1 year, i.e. 12 period rolling month time, was 13%. But while that's the average, you had a huge range of 167% on the up and 69% on the down. If you look at a balanced portfolio, 80% of the time you made money. The range was negative 44 to positive 74, and the average was 9.4%. If you look at T-bills, 98% of the time you made money. The range was basically from negative 1% to positive 17% with an average of 3. All right, so you with me so far there? So huge variabilities in stocks, huge average rates of return to 13%, and you made money 3 out of 4 years. All right, so now if we go to 10 years, 94% of the time over 10 years, you made money in stocks with a range of negative 6% a year down or 22% on the up. All right, so you had the variability decrease significantly from 69% negative to 167% positive to 6% negative to 22% positive. The average is 10% a year for any rolling 12-year, 10-month period, and 94% of the time you made money. Now, here's the problem, though. You ready? So basically, the issue is if you had a balanced portfolio, if you had bonds, or if you had T-bills, 100% of the times you made money, without question. 100% of the times in those three portfolios, you made money for any rolling 10-year periods. So the idea would be if you can hold your money for 10 years in stocks, there's a 94% probability you'll make money. But here's the problem, and this is what people always get looked at. They forget. You're always in this day. You're always in this time frame. You're never in this time frame. You're never in the 10. I'm telling you, man, you're always here. You're always sitting there saying, this is the year I could lose 69% of my money. I know it's only 75% chance, it's 3 out of 4 times I'll make money, and I know I'll average 13%, but this is the year I've got to contend with. And if I'm down 69% this year, I could also be down 69% the next year, because on each and every year, there is a chance I could be down 69%. And even if I'm not down 69% in consecutive years, there is still a 1 in 4 chance I could be down back to back. And if you look at 1 in 4 in any given 1 year, it means 1 in 8 in any given 2-year time. It happens. In fact, if we show you here, any 3-year rolling periods, you lost 44% of your money. All right, that's 3-year rolling periods. You made 42 or you lost 44. So you actually had more risk on the 3 years than you had on the upside for 3 years, even though you had an average return of 11%. But the problem is you never hit here. You're never at your 10-year time frame. You're never sitting there saying, okay, 10 years are good. I'm good to go. You're always right here. The worry is always here. The emotional aspect is always here. You never accomplish that. So let's just use this 10% for an example. That means you doubled your money every 7.2 years. So essentially, you just put $100,000 in. We'll say you have you basically $250,000 after 10 years. You're like, yes, I did great, but you're right back here. You're always right back at year one. That's what I'm trying to say. You always have that 69% fear of loss. You always have that 44% fear of loss over 3 years. You can't overlook that. You can't. So the longer the holding period, the lower that likely historical likelihood of loss is true, except for the fact you never get there. You never get to the goal. You're always taking the next step. That's the thing. It's like, well, aren't you glad you kept in 2000? Yeah, I am. But now I'm not. But that's hindsight. Now I'm worried about the next year. I'm worried about tomorrow. I'm worried about the next 5 years. Does that make sense? You're always worried about the future. The past is now the past. So, Josh, aren't you glad you didn't sell in 2009? Yeah. But there it is in 2019. I got Trump in there. I got Obama. I got this, that, the other, blah, blah, blah. Now I'm worried about the next year. And so just because the past worked out, I still know I have this huge significant decline potential for the next year. And I don't know if I can deal with that. So let's go with what my man Meyer says, because I think this is actually somewhat intuitive, or not even counterintuitive. It makes sense once you read this. So the probability of losing money is one thing. The amount of money that can be lost is different. So what he's saying is, look, yes, you might not lose money. All right. So he's saying over time, the probability of losing money is lessened after a longer holding period. So if you can convince yourself to hold it for 10 years, you'll probably make money between now and 10 years. My argument is even more simple than that. You're always in year one, always in year one. But he's saying, look, if you can hold it for 10 years, you're probably going to make money. But how much can you afford to lose in any given 10-year, 5-year, 1-year time frame? So let's read on, because I think that's another important thing. All right, you have $100,000. You now ended up with $101,000, but at one point you're down to $40,000. Hey, but I didn't lose any money. Yeah, it doesn't work like that. Human emotions come in. All right. So a time diversification centers on the belief that risk of stocks declines as investment horizon increases. That belief is shared by amateur and professional investors alike, often accompanied by graphs showing the probability of stock market gains increases as their holding period increases. Indeed, during 1926 and 2015, there were no 15 or 20-year periods with stock market losses. And here we're just showing you rolling 10-year periods. 94% of the time we had stock market gains, an average 10% a year. We did have a couple, one time we averaged 6% on the downside. Yet in truth, the risk of stocks doesn't decline as the investment horizon increases. Why then does time diversification belief still persist? This is the time diversification puzzle. Paul Samuelson, oh man, so Paul Samuelson is a bane of my existence, but in this case he brings the street cred for sure. Nobel Prize winning economist argued that the advocacy of time diversification is built on framing errors that mislead investors into an illusory happy ending, as if the probability of losses over the long run is zero. Exactly, the probability of losses over the long run is not zero. To understand the nature of these framing errors, consider an investor who invests $1,000 in a portfolio with a 50% chance to gain 20% or lose 10% each year. All right, so we're going to show you this figure right here. The investor has a 50% probability of losing money if her horizon is 1 year, but only has a 25% probability of losing money if it's 2 years. If risk is framed as the probability of losing money, risk declines as the horizon increases. But that's even wrong. But if risk is framed as the amount of money that can be lost, risk increases as the time horizon increases. So I agree with that though right there. The investor might lose $100 after year one, so $1,000 could lose 10%, and down to $900. But they could make 20%. So here's our 50-50. You could make 200 or lose 100, which is okay for you, all right? But after year two, the investor, let's just say they're here, they could lose 20%, or 10%, be down to $1,080, or they could lose all the way down here. It's a 25% chance of losing down to 810 because they lost 100 here, or 10%, and then they lost another 10% there. So we have 1-2 years where they could lose money out of 1, 2, 3, 4, 5 times, 5 situations. So we have 2 years. They could make money, lose money, make money, lose money, lose money. They have 5 situations, all right? So we have a 50-50 on each one. So we have they can make 1,200, make 1,400. They can make 1,200, lose 10%, be down to 1,080. They could lose 10%, be down to 900, but then make 20% to be up to 1,080. But they could still lose 2 times straight and be down to 810. So that means there's a 25% chance for a $190 loss. I 100% agree with that. 100% agree with that. And on top of that, there's I don't even know what the chance is, 25% chance, I guess, for a $80 gain. And that doesn't seem that much, actually, because they still had initially they had a 25% chance of, a 50% chance of $100 loss. But listen to this, it gets even worse. Samuelson noted the effect of time on the probability of losses can be perfectly balanced by the effect of time on the amount of losses. If so, neither increases nor decreases as the investment horizon increases. But what if investors don't assess correctly the probability of losses over the long run and overlook the potential cumulative losses of long-run losses? It's cumulative right here, so 1,000 down to 810. Many proponents of time diversification assume in error that the probability of losses with stocks held over the long run is zero. Economists James Glassman and Kevin Hassett, and Hassett, I think, is with a Trumpster now. And I'm a big fan of both those guys, actually, because they're right. They published a book, Dow 36,000, and a lot of people said, you guys are idiots, as they did with Irving Fisher. Yet somehow all the naysayers, the negative guys, never get run out of the game as the positive guys. It's weird. Let's see, Hassett and Glassman in September 1999, just before major stock losses in 2000, 2002, pushed the Dow down to 7,300. In August 2002, they wrote a column, Dow 36,000 Revisited. Higher returns are normally correlated with higher risk, they wrote, but work by Siegel of the Wharton School and others have found that if stocks are held over long periods, risk declines dramatically. Siegel, offered the book Stocks for the Long Run, looked at nearly 200 years and found that during the worst 20-year period ever, stocks rose in more than 20%. An investment professional wrote in Financial Analysis Journal, a positive return on stocks in the long run is a near certainty. There is no reason to expect a negative return on the broadest possible stock index. Yet there is a reason to expect a negative return even on the broadest possible stock index in the long run. The error of framing small probabilities as zero probabilities might be described as illusory happy ending error. As Samuelson wrote, when a 35-year-old lost 82% of his pension portfolio between 1929 and 1932, do you think it's foreordained in heaven that it would come back and fructify to 400% by his retirement age at 65? How did the 1913 Tsarist executives fare in the retirement years on the left bank of Paris? Exactly. I 100% agree with that. 100% agree with that. You're taking this and you're extrapolating that into the future, and you just don't know. Especially like this guy, 35-year-old, lost 82% of his pension in those 3 years of 1929 and 1932. It's all good. Stocks for the long run. Stocks for the long run. I'm just going to hang in there. 3 years of losses can turn investors with 30-year time horizons into investors with 3-year horizons. That's what I'm trying to say. Every investor is a short-term investor. Everyone is. They want out. Investors become optimistic after increases in stock prices and pessimistic after decreases. The argument that time diversification reduces risk is flawed, but is useful in bolstering self-control and mitigating fear and regret over losses. I agree with that. Time diversification comes with the stay-the-course rules, keeping alive hope of high future gains and countering the urge to sell stocks. But there comes a time when even long-run stay-the-course investment horizons are reached and hope for gains is gone. This is when the option to extend time horizons is most valuable. All right, so let's see. Flexible form of a belief that stocks pose no risk if held for the long run is false, but is useful for investors who are frightened by a stock market crash and dump all the stocks. I completely agree with that. So at the end of the day, the issue is, as I say a million times a Sunday, you can never time the market, A. You can never sit there and say the stocks are they're down today, so I'm going to get out so I can get back in when they normalize or something like that. You can't. You just got to recognize as long as you can hang in there long enough, you should be okay. There's no guarantee of that for sure. I cannot sit here today and say I'm going to slam my shoe on the table like Khrushchev at the UN and say we will bury you with stats that say you're going to be okay. We just don't know. But the alternative, that's what you always got to look at. What's the alternative? The alternative is a 10-year treasury bond at 1.75. And that's not enough. So you got to stay the course with stocks and just say, recognize, look, I'm going to hold these until I run out of money because there is no alternative. There's just not. But with that said, don't be suckered into thinking, well, if I just hold for 10 years, I'll be okay. You got to recognize every 1 to 2 to 3 year time frame is going to get dicey. It will. And when it does, remember, the alternative The damage is already done, essentially. The alternative is what? And that's what you always got to remember. So I know it's kind of wishy-washy, but this is the reality of the world here, man. Now, this is what I'm trying to bring to you on the channel. I'm not trying to sit there and say, just hang on for 20 years, you're going to be okay. We don't know. We don't know. In 1905, freaking, Alexander the Tsar there, whatever his name is, he didn't know the Bolsheviks were going to shoot him and his children in the basement. We had no clue. And yet, that was a stock's long run. Didn't last for him. Didn't last for the freaking, anyone in Germany. Didn't last for people in Venezuela. I mean, the history is full of stocks not lasting for the long run. Are we the exception? Yeah, absolutely. Will we continue to be the exception? Probably. But let's not be, just whistle past the graveyard here and say, oh, I just got to hold the stocks, I'll be okay. We don't know. We don't know. So the one thing we do know is pay off your debt. All right, we'll see you next time. Don't forget to smash and subscribe and hit the notification bell.